Welcome this morning. It should come as no surprise to any of you here that I love car racing. Those who know me from my younger years know that this was the car that I learned to drive on. And of course, this is the person that it belonged to. Now, does anyone know what kind of car that is? Any guesses? It'd be worth your while. Is it a Ferrari, a McLaren? You're close. Ford, Fairmount. Who had the closest? All right, Matt Roberts, this is for you later, buddy. Now, I said it was her car. She did not teach me how to drive. Actually, that award goes to a guy named Joey Frangione. Joey taught me a lot of life lessons. I am not sharing any of them with you here today. Back to my grandmother. So she certainly didn't teach me how to take corners at 180 miles per hour, that's for sure, but what she did teach me was to pay attention to the environment around you, anticipate with caution, and adapt. When we met a year ago, we talked about the impact that high interest rates and a muted exit environment was having on the overall ecosystem. Since then, we continue to monitor this cautious exit environment, investment environment as well, settling inflation, and the good news, the start of interest rates easing. The rain seems to be letting up, but drivers haven't started to pick up their speed. Just like F1, venture is a formula that involves taking calculating risk, operating at unthinkable speeds, and of course, adapting fast to the competition and conditions that are around you. In extreme wet conditions, speeds are reduced by up to 40%. Drivers stay focused, making way fewer aggressive moves, and they drive with a sense of frustration. Raise your hand if that sounds familiar to anybody in this room. Believe it or not, 2023 was the wettest year in F1 history. That's wetter than any other year since it was founded in 1950. By the way, remarkably, around that same time was when the very first venture investment was recorded by the American Research and Development Corporation into a company called the Digital Equipment Corporation. Do we have any guesses as to how big that investment was? And there's bonus points if you know what the valuation was. Any guesses out there? Okay, I'll help you. Was it 70,000, 700,000, or 7 million people? Who said 100? I didn't give you those options. Okay, bonus points. I heard 70,000, bonus points for valuation, people. No, we actually heard the answer from Naeem earlier. The answer is the valuation was $100,000. So that's dilution if ever there was some. Back to the races. Capital is being deployed as if it's been following the safety car for the last 18 months, and it makes sense. Since 2022, we've been dealing with high interest rates that have been hovering around 5%. The high cost of capital has led to a significant reduction in corporate spend, and of course, a pullback by LPs into the riskiest asset class. And so far in 2024, this year can be best described as a year of concentration. There's a lot of cars at the front of the pack. An unprecedented amount of capital has gone into a small number of companies. In the last quarter, the top 10 deals, which I will tell you represents 40 basis points of the overall deal volume, accounted for a third of capital that was invested. And while mega deals inflate average deal sizes, deal counts continue to decline this year, particularly if you look at seed and later stage. There were signs of modest acceleration of funding in Q2 when total funding in North American tech actually surpassed $40 billion for the first time in over a year, despite what I discussed before, the deal volume retreating. Now, the number of funds participating in rounds, that's decreased significantly. Several years ago, when we got together in Waterloo, we talked about party rounds and tourists. Those were micro VCs and solo GPs, industry executive, angel list syndicates, scout funds. All of them remain idle in the pit. Crossover funds, who were once the darling of venture capital, lots of capital at high valuations, they have retreated, and they've been quiet for the last 6 quarters. And corporate venture participants have been active, but mostly in higher-priced AI deals. So less participation means less capital. Round sizes have been moving in tandem with valuations, and that indicates that dilution across almost all of the rounds remains unchanged, but with less capital invested than we were seeing at the peak. So companies must continue to do more with less. Ironically, F1 has a cost cap. 3 years ago, it was $145 million. Today, it's $135. Despite their success, they too are retreating and spending less. Now, just like coming out of the pit strong, investments depend on being next round ready. Since 2022, only 15% of companies have graduated from a seed to Series A, and 33% of Series A companies have gone on to raise a Series B. That is about 50% of what we were seeing at the market peak. Down rounds reached an estimated 21% this past quarter, and for those that successfully did raise, the time between funding rounds reached 28 months. That's the longest that it's been in over a decade. The funding crunch is real. So to summarize this first part, average deal size is improving, volume is remaining at 2017 levels. Less frequent rounds and lighter balance sheets are demanding that the majority of our founders continue to race, but with fewer pit stops and tire changes. Focus on revenue-generating products and away from more experimental and capital-intensive projects, adjust tire pressure, rebalance and align, and avoid overloading. Of course, that's what the Magnificent Seven started doing in 2022, when they aggressively cut spend, and it paid off. Much of the public market gains over the past year and a half are from S&P's largest 7 stocks, otherwise known as the Magnificent Seven, which account for 32% of the overall market cap. That is more concentration. And it's easy to imagine that the combination of valuable equity, a strong balance sheet, and a history of growth through acquisition make the Magnificent Seven ideal buyers in this market. Well, it turns out that the DOJ and FTC, well, they've thrown up the black and white flag, and not the one with little squares, the ones with 2 big triangles. Any guesses on what that flag represents? Oh, come on, guys. Unsportsmanlike conduct. We need some participation here. Okay. It's a little bit actually like the FIA stepping in and requiring Red Bull to modify their braking system this year. Look at what that's done for McLaren. Huh? So anyways, almost all of these companies are being investigated on antitrust-related matters, and they're avoiding any actions like acquisition that may draw government attention. Instead, companies like Google, Amazon, and Microsoft, they've engineered creative ways to access top AI talent through what they're calling reverse acqui-hires. That's where they hire small founding teams and then agree to a perpetual license fee with them throughout the ongoing term of the company. There also may be other much-needed sources of public market acquirers on the horizon. We're seeing a strong rotation into small cap and mid cap stocks. Since the end of June, the Russell 2000, which represents the smaller companies traded on S&P, that's outperformed the S&P 500 by 5%. So as these stocks become more valuable and borrowing costs continue to decline, conditions are becoming riper for M&A activity. And we're actually starting to see an uptick in acquisition spend. However, revenue multiples remain low at around 5.4x, which speaks to another reason why companies are staying private longer. Many of these companies have exited at substantial discounts to their last round, including public deals. And while the 24 IPO cohort has had strong performance in this year's market, the bright light shines on Reddit, which is now trading at its private market valuation peak of $10 billion, and that's after listing at a 40% discount. We also observe a resurgence of startups buying other startups. Reports are that this has been as much as 40% of the overall M&A deals done in Q2. And that's the highest percentage we've also seen in more than a decade. These acquirers have strong balance sheets. They can continue to raise capital while some of their targets struggle to fundraise and anticipate choppy waters. The 2-year IPO and exit drought, it's caused VCs to also start thinking creatively. And secondaries have become a primary form of liquidity. The combination of exchange marketplaces, funds establishing themselves as RIAs, and large, dedicated secondary funds has resulted in over $70 billion being used this year to purchase secondary positions directly in deals and funds, and that's up 58% over last year. This trend is going to continue for at least another 12 to 15 months, as there's an estimated $135 billion in secondary dry powder, and funds are able to buy large preferred positions at 30 to 40% discounts, and that's in contrast to the 10% average that they were paying as a premium in 2022. So the race card's also been set for funds themselves. We're on a slightly better course than we were last year. Funds have raised $40 billion of new capital. That's ahead of the 33.3 that was raised at this point last year. That's in North America. But that is still a fraction of what was raised at the peak in 2020 and 2021. There's optimism that companies that are deciding or being forced to wait for the next round of financing will have capital. Over $420 billion is estimated to be available in dry powder, and certainly lots of this is going to be earmarked for existing investments. But expect a wave of capital to land in later stage deals that have a shorter horizon to exit, as funds look for short cycles on the investment side and short cycles on the liquidity side. I believe that this activity at the top of the market has the power to catalyze earlier stages as the yellow flag stops waving and the race starts to return to normal. Thankfully, the interest rate step down that we referred to before, that's begun. As that rate approaches 3%, we're going to start to see the full impact on the investment and exit cycles. That's likely somewhere between 3 to 5 quarters away. So in summary, there are new buyers and there are new buying models. There are discounted acquisition prices. In the short term, we're going to see more acqui-hires. That's going to persist along acquisition of slower growth, profitable companies. And there's lots of dry powder out there. That's going to target growth stage companies and eventually catalyze earlier stage investments. So where does that leave our companies? Well, like all companies in the tech space, they've had to deal with reducing their headcount, creating alternative sources of income, and reprioritizing to do more with less. We have some companies that are driving with a check engine light on and several that are nursing their cars back into the pit. And like the rest of the market, we have dry powder to support other opportunities where the overall return profile will have a material impact on the fund. And we also expect that there are going to be other deals where we're going to be able to liquidate our position, even if it's a little bit less favorable than what we thought it was going to be at the peak of the market. But those assets I've talked about, those are overshadowed by our top performers. They remain very well capitalized. They continue to adjust their burn accordingly, and just like Hall of Fame drivers, they stick to their strategy while they adapt to current conditions. How about new investments? Well, our focus remains unchanged. FinTech, prop tech, sports tech, urban tech. We still enter at the earliest stage, and we work with our drivers and their pit crews to get them race ready. This year's crews are launching businesses in an era that has been defined by profitability. These founders that we've invested in, have deep expertise in the markets they're selling into, and they're building products with immediate impact. We've prioritized price rounds over safes and convertible notes, and this year's cohort of our seed deals are in a combination of near market and market-ready companies that have been all priced competitively. we're partnering with fewer, more traditional funds who understand that the race is long, but the season is longer. Throughout the day, you'll be hearing from Team Relay's group of drivers. Just like their F1 counterparts, you'll get a sense of their competitiveness, their confidence, their team focus, and most importantly, their desire to win. So sit back, relax, buckle up, and enjoy the race. Thank you very much.